Let's talk about the oil marketing companies and HPCL in particular. What exactly are the factors at play? Is there a GRM risk for the space as a whole? Ajay, who tracks the sector very closely, joins in with some perspective. So, Ajay, let's talk about the factors.
Well, Avan, that's correct. HPCL is in focus. In fact, right now also, if you look at the F&O gainers list, it's almost the second, third stock there because it started witnessing a lot of buying once again after last couple of months of a weak patch. On the concerns that marketing margins were under pressure, but now marketing margins are rebounding. However, the core refining margin, even for the entire region, the Singapore refining margins continue to remain on the softer side. That remains the niggling worry. But oil marketing companies are progressing on gas side of the business, bagging new rights for new regions for city gas, and the reversal of marketing margins coming back seem to be enthusing a lot of faith in these stocks by the market, and we are looking at a lot of fund buying starting to happen. So there is definitely a lot of case to revisit all these matrices we spoke about, and Mr. Surana will be joining us on the show today.
Okay, so we'll take the conversation forward. Mr. M.K. Surana, Chairman and Managing Director of HPCL, joins us. Mr. Surana, how would you characterize the current business environment for HPCL? Crude prices are higher than where they were at the beginning of the year, but they are much lower than where they were from the peak of last year. In your current marketing spread, are you making money or are you just break even?
Good morning, Nikunj, and let's divide into two different parts. As far as the crude prices are concerned, it is running around 65 to 66, and if we see the last quarter, it closed somewhere around 57. So last quarter we had a reasonable amount of inventory losses, but this quarter we are not expecting that. That's one positive. Second thing is the MS cracks, which has been very weak in the last 3 quarters almost, which was running, sometime it even went to negative. They are slightly firming up. It is running around 3 to 4 now. As far as diesel cracks are concerned, they had been good and they are further firming up. So as far as the overall cracks are concerned, there is some positive. Because of the crude price firming up, inventory loss worries are lesser, and the dollar debt is maintaining in a reasonable range. So that gives some comfort level on that. As far as GRMs are concerned, because there were lower MS cracks, the GRMs had been under pressure in the past. Singapore margins had been running in $2 to $3 or so, but if the crude prices are going up, the Indian refineries tend to do better as compared to Singapore GRMs. And Indian refineries are more designed for diesel maximization mode, and diesel cracks are firm. As far as marketing margins are concerned, we are able to make a reasonable amount of margin on that, and so definitely it is not a breaking game as such. So the benign international product prices, a reasonable exchange rate is helpful to us to ensure that we are able to price the products reasonably in the domestic market, which is affordable by the consumers, and it is reasonably good for the oil marketing companies' bottom line as well.
Mr. Surana, hi there. Can you also update us first? Have you stopped taking a hit on the overall marketing margins as well now that crude is low? I know you touched upon it, but if you could just give us more clarity here. And how much are you making on it?
No, I said that we are able to price the domestic products, which is in line with the international product prices on day-to-day basis. So because Nikunj asked that whether it is breaking, I said it is not breaking. We are able to make a reasonable profit, and at the same time we are able to maintain the affordable consumer price.
Okay, fair enough. Now, we have also seen the differential of heavy and light crude. That seems to be getting narrower due to the points that, we've been talking about, the overall benchmark, Singapore complex, which has remained weak. Can you tell us how do you see this impacting an OMC like yours?
See, because of more supply of crude oil from US, which is a lighter grade, and tightening of the supplies from Middle East because of the OPEC cuts, etc., that differential is reducing, where the light crudes are available, and the heavier, when the cut is done in the OPEC basket, the heavier crudes are cut first because they are lower price crudes. As far as the Indian refineries are concerned, the refineries with coker, etc., they prefer the heavier crudes. But as far as HPCL is concerned, we don't have the cokers. So actually it does not impact us substantially as far as the heavier crudes are concerned. But actually, to some extent, it can help us in if the lighter, heavier crude differential is lesser, provided the overall crude crude prices remains on the lower side.
You know, the benchmark Singapore complex continued to remain weak at about $2.7 per barrel, primarily on extremely weak gasoline crack spreads as well. Usually when the cycle turns around, just wanted to understand how prolonged can it remain on the downside before any meaningful revival comes in?
No, the Singapore margins are calculated on days crude and days products, while what we do, or what are most of the refineries do in the Indian context, is based on the actual crude purchase and actual product supplied. So there is a time gap in the way the GRMs are calculated actually by us versus the way the benchmark GRMs are calculated. The second thing is the product slate which is considered in Singapore GRM is slightly different than the actual product slate of each of the refineries. So normally when the crude prices are going up and the product prices are going up, the Indian refineries GRMs will be better than the Singapore margins, and if the product prices are if they going down or the crude prices are going down, the Indian basket will be either the same or lower. Now, so to that extent, because in this quarter the crude prices are going up, so I expect that the Indian refineries GRMs will be better than the benchmark Singapore margins. Singapore benchmark margins has been on the lower side because of the lower cracks on the lighter products, especially LPG, MS, naphtha, and partly offsetted by the better cracks on diesel. Of late, the FO cracks had been good. To that extent, it is slightly balancing, but because the Indian refiners have higher diesel component in their product supplies, it is getting balanced to that extent. Now going forward, the MS cracks may be slightly firmer, but we are not expecting it to be going substantially high. Maybe in the Ramadan months there may be additional demand for MS. Then after that, US driving season will start. To that extent, there will be some improvement in MS cracks, but otherwise the MS cracks are likely to be lower side, and they are not likely to hit the earlier cracks which we have seen once upon a time, double digits, etc. But the diesel cracks are likely to remain firm, and to that extent it will be helpful. There is some firming up of cracks on LPG also of late.
Right. And what about overall crude prices? Because they found somewhat support primarily on renewed production cuts by OPEC in January and sanctions on Iran as well as Venezuela. But from here, what is your view on where prices are likely to head?
So the crude prices are trying to balance itself in a supply weakness and the demand tightness, the way we see it today. So on the demand side, because there is a lower projection of growth from European Union, from China, that is giving some worries on the demand side. As far as supply side is concerned, there are some cuts from OPEC side. The Venezuela issue has helped to maintain those cuts, and though it is of course related to sanctions, Russia cuts are now will be reflecting it. But come H2 and the production from US after removal of their infrastructure constraints, especially in Permian Basin, may unlock some of the production restrictions which they have, and that may bring additional crude in the market. Right now, the way we see it, the 63 to 68 range, which I said earlier, also looks more likely. You will see occasional spikes, but those occasional spikes I don't think will be sustainable for a longer time. So I still think that it will be 63 to 68 range.
Okay, thank you for taking time out and joining in, giving us a sense as to how you see the overall crude oil price trajectory, as well as how you see Indian refiners performing in this environment.